Good afternoon. This is Bakes, Kevin Baker. Welcome to Bakes Takes Podcast. This is from Saturday, February 27th. A lot of fun. Between caffeine and Van Halen, I'm pretty worked up again today. So here we go. Number one, GameStop, a pretty elastic cat for a dead cat. Number two, allergic to red. I'll explain that. And number three, being right versus making money. And they're all germane. So here we go. Why I do this, real quick. Bobby, Jack, my sons, they're in their 20s. And while they were in undergrad business programs, they would call me up and fire questions. I've got 30 years in hedge funds and mutual funds and what have you. Went through the 87 crash. And so they and their friends would fire questions at me. You know, what's the long bond doing? Why do I care? Are stocks under or overvalued? What are the trends? What groups do you like? And I enjoy it. So I put it on steroids, got Mike to help me out, make me sound better than I probably am. And I coach. And I talk to them, and I invite you to listen in. I am steeped in technical analysis because that worked, particularly with the timing of 87. I think it's a great timing tool. I deploy that first to attract me to do more fundamental work. It's not right or wrong. That's just the way I do it. That's my chronology. I read the things that maybe you don't want to. Barron's, The Economist, etc. Listen to dozens of podcasts. I devour newsletters. I monitor what my Google alerts are spitting out. And I point you to them. I always give attribution. If you don't want to do all that work, just know that I'm doing it for you, and I eat home cooking. All I do is talk about the investments I have and what I'm interested in. Pretty transparent. My disclaimer, this is not investment advice. Please conduct and share your own due diligence. Huge week for fan mail, Mike. First, I got my son Bobby's text. What's going on with GME? And I said last week, this is literally the chart, if you're looking at my YouTube channel, which I encourage you to do, because the visuals and the charts are very helpful in my view. And this is the chart from last week. And I said, I made, a cute remark, from roaring kitty to dead cat bounce. And dead cat bounce is a crude Wall Street term that even a dead cat will bounce if it falls from a great height. And when you go from 22 to 483 like GameStop did, and then crashes down 90% to 40, that certainly qualifies as a great height. I thought that was the floor, and a bounce to 65.77 ceiling would be it, in my opinion. And I was wrong, and I'm going to try and be transparent. I'll tell you when I'm right, and I'll also tell you when I'm wrong. Now, being wrong on GameStop is not tough because this is a crazy situation. And this week, the Reddit crowd talked it up, and it broke through the 77 price level that I talked about before. That's probably support now. This is so volatile. It's absurd. There's a gap at 212 that we might fill. I think that's going to be really difficult. I'll talk about that. I'm still staying away on both sides. You can't borrow the stock. It would cost a fortune to borrow it, to short it. And there's so many other things to do that don't create the blood pressure increase that this entails. And a question that I would ask all of you, whether you're in GameStop or not, or maybe particularly with GameStop, are you red? And by that, I mean the Wall Street convention is green is up and red is down. And if you're red, I want you to seriously think about what are you doing this for? If you're doing it for a dopamine hit, great. Enjoy yourself. But if the point is to make money, then I want you to become allergic to red. And I'll go into that a little bit more, but I think GameStop is an unanalyzable situation. Maybe in the base from 4 to 22 when Roaring Kitty wrote it up, it was a different story. I think now it's just nuts. Now, the reason why I said 65 to 77 was going to be the lid was the short interest, and this is even more updated. I talked about they mopped up the kerosene, and your matches don't matter, and it's still going to be a great country song. I'm talking to Brad Paisley tomorrow. But it's plummeted. It's now down to less than 30% of the float, and so something has to happen fundamentally for GameStop to go up much, in my view. You don't have the short squeeze component the way you used to. And oh, by the way, on Reddit, all the hedge funds that are supposedly the man, they're on Reddit too. They're just hiding behind different usernames. So it's not the the monolithic march on Wall Street that it's portrayed to be, in my view. So a lot of the kerosene's mopped up. I thought enough had been that we were not going to get this kind of surge, and I'm wrong, but it doesn't matter because I don't own it. So here's my take. If you own it, I would become allergic to red, and the goal is to make money versus being right, and that's an old Ned Davis expression. Wrote a whole book on the subject, and that's it. I don't care about diamond hands or any of that stuff. And being right at making a statement is irrelevant. The goal is to make money. And if you see red on your screen, I take losses at 15%, and I encourage you to find some rule that works for you so that you don't have big losses that demolish the portfolio. That's my humble opinion. Next, the voice memo from Murph.
And then just another question for you. I know that the show often touches on Bitcoin and specifically Grayscale Bitcoin Trust, but was wondering some of your thoughts on Ethereum. I personally have been a long-time holder and have been super bullish on the actual technology behind it, with the practical utilization of smart contracts and the idea of Ethereum being a more feasible store of value compared to Bitcoin. Wanted to hear any opinion you had on this. I know Grayscale now also has an Ethereum fund too.
Mike, these are the kinds of people that we're attracting. I mean, Murph's a pretty smart fellow. Great to hear your voice, Murph. Appreciate it very much. And here's my bias. I always go chart first, and so my eye likes and liked the Grayscale Bitcoin Trust, and Ethereum didn't catch my eye for a host of reasons. So I just prefer the Grayscale Bitcoin Trust because of that. It is still above its 50-day moving average. It paid its respects one time, almost to the penny, as we've talked about on a prior show. It's up 183% since we bought it. Doesn't happen very often. It's pure profit. When it doubled, I took half off the table, so what I'm left with is just pure profit, which lowers my blood pressure and enables me to have more flexibility with this multi-year trend. This is the crypto that companies are putting on their balance sheet. And so a great question from Michael Saylor, the CEO of MicroStrategy, might be, why didn't you pick Ethereum? I don't know what the answer to that is. The other point I'll make is cryptocurrency, crypto assets, whatever term you prefer, I feel should be a small percentage of your assets. I said, 3, 5, or 10 the other day, a little bit flippantly, but this should not be, mortgage money kind of commitments. And because of that, do you need two? I don't have any reason why Bitcoin is going to go away entirely and Ethereum is going to take over. But so that's my initial thoughts. So here's the Grayscale Ethereum Trust. It's about a fifth of the Bitcoin market cap, so it's a distant number 2. Smart contracts, Murph, it sounds like you've forgotten more than I know about smart contracts and the underlying technology. But my tiebreaker is always the chart. And here, for both of them, to be fair, the volume is going up on the down days. Yes, I say this every episode, but it works for me, and I'm going to keep saying it until it doesn't. So I'm watching that, but this has come down through the 50-day moving average. The volume's picked up a little bit more than Bitcoin, so I'm watching it. And again, I look at these charts. I went through 1,700 charts into the wee hours of the morning last night. So I look at everything, hopefully with a dispassionate eye. I could change. Yellen, for some reason, Yellen's statement about cryptocurrency not being I forget her exact term, but not being an efficient source or an inefficient source for transactions, something along those lines. And that's obviously understandable speak for a Treasury Secretary. She's going to say something else next Monday, too, and Powell's going to say something on Monday after that, and there's going to be a congressional hearing on Monday after that. So just be ready for this kind of volatility. I think both are probably going to work. I just prefer Bitcoin, given it's a small percentage of what I do. So that's my take. I prefer Bitcoin. It's a small percentage of the assets, and as always, I will tip my hat to the chart that I prefer, and that's what led me to Bitcoin in the first place. The next voice memo, please. Mike.
Mr. Bakes, how's it going? Thanks for taking the question. As you saw in the email that I had sent you, I kind of have a few questions or topics to talk about. So just for these voice memos, I'll just try to keep them short. So I know you recently talked about wanting to add some more positions to your portfolio. So I was wondering if you consider the semiconductor space at all. I personally have been intrigued by SOXX, SOXX, which is BlackRock's semiconductor ETF. It holds a lot of the big players in the space, such as Intel, Broadcom, NVIDIA, and seems to offer a nice blend of domestic and international holdings. Obviously, looking at the chart, it's very bullish over the past year, perhaps even overextended. But was wondering some more outlook that you had in the space. I know the recent supply shortage of chips relative to super high demand in the space has been a hot topic in the news.
There's some smart cookies on this show, you know. Okay, Murph, appreciate it. This is the iShares Phlx Sox ETF, SOXX, the symbol. The only negative I have, it's going to clear uptrend. The only negative I have is the volume pickup on the down days. Again, here I go, and I've got red arrows that I've added this time around. This could change. It's not a buy for me yet. The chip shortage is being talked about, it seems like incessantly on CNBC, and I'm sure on other networks. The sector's history is that they overshoot and the shortage turns to glut and prices fall. Now, that takes some time, but I question what is built into the expectations for the shortage playing out, what's built into share prices, and that's why I go to the chart first. And this is my next point. You mentioned NVIDIA, and this is everyone's darling, and it might be symptomatic of what's going on with the semiconductors overall. Everybody loves this, and they had blowout earnings this past week, and the stock sold off. And so when you can't earn enough to keep your ardent fans happy, that's a sign that at least you have to digest your prior gains. And that's what I think is happening here. So my take is expectations are likely too high for the semis. I'll go through them every single month. It's not a buy for me yet, but I'll certainly alert you if things change. Next, please, Mike.
And then just one final question. Sorry about all these questions, but I know I've asked you about ICLN before, which is BlackRock's clean energy ETF. And I know you broke down the technicals then and said you believed it was overextended, which you seem to be spot on about. But recently it's definitely seen some pullback, especially this past week. The chart below, which I included in my email to you, shows a massive drop on huge volume. I was wondering if you could help me decipher some of this and if you still believe this is overextended despite relatively flat trading since your last time you addressed it and now with the recent pullback. This is more of a long-term play for me anyway, so not really overly concerned with the bumps along the way, but just curious to hear your outlook.
Murph, love it. And I love, thanks for the shout out for the prior call. And I want to have a lot more of this because this is where I think I can really bring something to bear here. Because your eye about charts is getting better with every interaction that you and I have. This is the iShares S&P Global Clean Energy. That's a mouthful. ICLN, and it's wind and solar. It's a Biden beneficiary, and as you can see on the red arrows that I've drawn here inexpertly, but here we go. You had this big breakout at the start of the year, and 23 million shares traded. That's way above normal, and you have a gap up, which suggests that I drew an arrow there as well. You've got such pre-open buying demand that the price of the ETF leaps and creates a gap on the chart. It's a very bullish sign, and clearly acted really, really well. Since then, so you have, and I drew another line here. 2420 is support. and we've come down after that extended move to pay respects to the support level. I drew the other arrow here. Yeah, it's a pretty high volume down day, 16 million shares. That's above normal. But then a subtlety, which is telling, is that it closed at the high for the day. That's the upper right arrow that I show there. And so when the market drills down a sector, in this case clean energy, but then by the end of the day, the last half hour or so, cooler heads, stronger hands, whatever you want to use, they want to own the shares at around the support level and higher, and it closes at the high. Pretty bullish sign. So I think for the long term, you're okay. So my take is, I think it's a decent entry point for ICLN. Murph sent me a text. He's all over me this week. God bless him. Asked about DBA, which is the Invesco Agriculture ETF. And I said in response to him, I already have a lot of agriculture exposure via tags, TAGS, the Ethereum agriculture ETF. And he says, is this a recession play? And does it act inverse to the market? And I'll say this is not a recession play. I think that if anything, the economy is heating up pretty dramatically, and for very solid reasons. So I don't think it's a recession play. I do think that it moves somewhat to the inverse of the rest of the market, because I think it's coming out of a multi-year downtrend, and much of the rest of the market, i.e. the FANG stocks, etc., has enjoyed serious multiple expansion because of the lowering of interest rates of the Federal Reserve. And the first time, whenever you ask me a question, I go to the chart first, which is here, and then the next thing I do is go to the fact sheet, which I encourage you to do. And what it turns out is that this agriculture ETF, the DBA, is much broader. It not only has corn, wheat, soybeans, and sugar like Ethereum does, but it also has cotton, cattle, hogs. So it's a very broad-based ETF, which is okay. It's just that my eye didn't get drawn to that the way it occurred with tags. Now, and this is one of the, I think, the benefits of letting charts guide you to a large extent. I prefer tags, and what it turns out is it's 25% corn, soybean, wheat, sugar. And I didn't come in with a macro view, because I seldom do, but what it turns out is that China has to rebuild its hog herd, which we've talked about here before, and corn and wheat and soybeans is what the hogs eat. They were decimated by disease 2 years ago. I had to kill a lot of animals that they couldn't consume, and this ETS has more exposure to that dynamic. It's smaller, which I like as an individual investor, where you have a less liquid alternative ETF, where if you have new buying interest, it can move the price up more than it might otherwise occur. And then, as luck would have it, this week in my pile that I tweeted out that I was reading into the wee hours, AgWeb had a story. Can you move that up, Mike, please? By John Sheave. And this is astonishing. China may import 40% more corn than in the last 60 years combined. That's a monstrous dynamic number, and clearly that's going to benefit corn, wheat, soybeans a tremendous. I mean, in this case, corn, but it points to the larger story that China is driving a lot of demand for this commodity and others. So my take is recession is not a risk right now. Inflation is, and we're seeing commodity after commodity acting just like this and benefiting from China demand and global economic activity. And I like tags more than DBA for right now, and I'm going to stick with that. So that gives me pretty good exposure to agriculture. And I just put this in this section just because it plays into this. Bonds are sniffing this out. And when bond yields were half or less than half of what they were, I indelicately said that bonds suck. And I put that out several times. And the only question is how negative this becomes. It's a sport on CNBC to dismiss the rise in bond yields, saying it's for good reasons, the economy's strengthening. And I say, okay, but it's just a question of how negative it is for stocks. You can't make it a positive for stocks to have competitive from risk-free treasuries going up. I think you can have stocks go up, but you can't say that it's a positive that interest rates are rising. And yes, this is the long end of the curve, and yes, the Fed isn't going to do anything on the short end of the curve. But I just think that the bond market is very sensitive, and it is reading or analyzing the charts that I am and seeing oil, copper, etc. going north, and it's adjusting the yields accordingly. So here's my take. Bonds are reversing 40 years of appreciation, and to act like it's going to stop after one or two, I just think is hard to imagine. And so stay tuned. I'm going to be watching bonds like a hawk, but I'm short them via the TBF ETF, and I think that so far it's working, and I think it's going to continue to work. Bobby sent along a chart to me, my son, about the Buffett indicator, and this gets a lot of play, and it's basically stock valuation versus stock market cap versus GDP, and it's a imprecise timing tool, but we are where we are. We're past the 99 and 2000 valuation peaks. And the retort is going to be, well, interest rates are so low that adjusts for it. But if you look at the chart, it's pretty telling that it's hard to make a case that stocks are inexpensive and that we have a lot of upside. We can make money in stocks. I just think you have to know. It's sort of like the old mall maps. You are here. This is where we are. Stocks are expensive. Period. End of discussion. And I think it's why bonds matter. And as bonds become better competition for capital, you're going to see valuations come in. And we're starting to see that already. It isn't cataclysmic, doesn't have to be, but acting like this is a bear market trough, it is not. We're at elevated levels. So my take is valuations are poor, and they can't handle rates going up much more. That's my view. I'm watching the 200-day moving average, that's part of my sell discipline, which I think I'm going to revisit because I think everybody talks about how to buy stocks, how to buy ETFs, but I think selling is it's obviously half the equation. It gets short shrift, and I think I've got a system that is dispassionate that works pretty well, and we'll deploy it at some point down the road. This is from James VanDeventer, great fan of the show. Bakes, like the show from the weekend, especially your comment about Bitcoin showing up on Treasury balance sheets. Thinks there's still a clear supply-demand imbalance, at least for now. I agree. Curious what you think about emerging markets, EEM specifically, making new multi-year highs right now. With a theoretically weaker dollar, would that have fuel to the fire? And then asked about what do you think of the reversal yesterday, I think, of the broader stock market, the Nasdaq in particular. This was Monday. I've never seen anything like that. Some of these AM prices and growth seem ridiculous. Good stuff as always. James, thank you. And I responded to him right away, as I will to many of you if I can and I have the time. And I wrote down that the EEM uptrend appears intact. And then last night, I went through all the charts. It's rolling over a bit. It's come down through the 50-day. The volume is picking up. It's not a fresh money buy for me. If you hold it, I would watch the 200-day. As far as the reversal, if you mean the overall market or the Nasdaq, I think you have to thank the 50-day moving average. It came down and touched that and rebounded. And Powell, Chairman Powell, after was giving testimony. And he says he thinks there's no inflation above 2% for 3 years. And I want to buy him a chart book or get him on the show. He's looking at different charts than I am. I don't understand it. I think he's sincere, but I don't understand what he's looking at. I really don't. And he doesn't care what Bakes thinks, but I shorted the 20-plus year Treasury via the TBF because I can see what's going on. The Fed can influence the short end. They can't do much about the long end. So 20 years plus, the Federal Reserve doesn't do much of anything. So appreciate the question. I hope that's helpful. Next, I have the EEM chart. I kind of reversed the chronology here. Sorry about that. But this is a big volume pickup on the EEM. And this could be, reverse to the upside. But if it does, I want to see the volume pick up. I want to see a new base develop here and before I touch this. And so you bring up another point, James, and here's my take. Macro is very tough to do, meaning I have never been good. Maybe some people are, but for me to say that I believe interest rates are going to do this, so the dollar will do this, and that emerging markets will benefit, that hasn't worked for me. What has worked is I go through my 1,700 charts, and I see something going on in a sector or a country or a theme that invites fundamental analysis. That has worked. So it's a bit of a subtlety. I don't have a PhD in econometrics, but I can read a chart, and it works. So I'm not going to buy EEM anytime soon, and I didn't find any other emerging markets ETFs over the weekend to get me excited. So. And do me a favor, everybody. Please share this with your Robinhood friends, your Reddit friends, your Wall Street Bets friends, or anybody, and send stocks ideas like we just talked about, and I'll offer my strategy for them. If you think I add value, please stay tuned, and I really appreciate your feedback, so keep it coming. Thanks. Next segment is my themes and groups, and I keep my feet to the fire, and here it is. Here's my portfolio. And it's up 12.89% year to date, and the S&P is up less than 2%. So that's not bad. That's not bad. I'll take it. And I bring up a point because I'm consistent. There's no red. There's red on the daily, but from inception, everything's green, and certainly nothing's down more than 15%. And I really encourage you to adopt this. It's just math. That if you cut your losses and let your winners run, good things happen. And we've all done it. We've all had an idea that we thought was surefire, and it goes down 15%, and you say, oh, okay, it's going to bounce. And then it's down 30, and then it's down 50, and then you're saying, well, I'll sell it when it gets back to break even. Now you have to have a double for it to break even, and that doesn't happen. So I just find that if you keep your losses to 15%, that it's about as optimized as I've been able to find, so that you're not trading all over the place every time. I can find 20% winners to make up for my 15% losers. Clearly. So I invite you to adopt that. You won't, because it's tough to do. It's a muscle that you need to exercise, but I really recommend it highly. Get allergic to red, and I hope that helps. So YOLO is up 83%. This is the Advisors Pure Cannabis. This is an active ETF managed by, I forget his name now. And here my thesis is simple and intact. States need revenues. And so instead of raising taxes on wealthy people and sending them to Austin and Miami, they can allow cannabis, have formularies, and bring in tax revenue relatively painlessly. And so this trend is intact for a long time, in my view. And I'll alert you when there's a dent in the thesis. I don't see it now. North Shore Global Uranium, URNM, that's up 75% since we bought it back in July of last year. I mentioned I'm bullish on uranium, right, Mike? Okay. He's nodding, by the way. And I think this has years to go, and I think it's very, very straightforward. The Fukushima accident occurred 10 years ago, and all the things you would think would happen happened. Demand plummets, nuclear plants get shuttered, and supplies swamps demand for the foreseeable future. That's all reversed. Now it's time. Nuclear energy is growing, and the mines have not been as productive as they need to be. You need higher prices to induce people to get this out of the ground, and it is happening. So I'm as excited about uranium as I've ever been. My next is the Global X video game esports ETF Hero. That's up 27% since we bought it. Those aren't year to dates. That's just since we bought it. So it's a little bit different. And this plays into the GameStop phenomenon. The stocks that are propelling this higher, they're all subscription streaming services, and almost all of them are. And so, again, I mentioned last week, could GameStop announce that a SPAC has merged them with Epic, and they're now a digital gaming play? I mean, I say that tongue in cheek. I don't know anything about either of those businesses really, but I don't understand how GameStop can become a digital player. I'm sure people are working on it, but something has to happen to justify the valuations that GameStop is commanding right now. Next is copper, Global X copper miners, and this plays into my Powell comments. I mean, commodity after commodity after commodity is going up, and a lot. It's up 26% since we bought it. This is a low volume pullback, and this is the best economist I've ever found. The economy is expanding. Housing, autos, especially electric vehicles, need a lot of copper, and I think this continues for a long, long time. Next is the Amplified Transformational Data, Block BLOK, aptly titled ETF, up 16%. These are all the sort of picks and axes play for blockchain. MicroStrategy is in here, Square's in here, for example. And this pullback to me, looks very reasonable. The volume has picked up, but not monstrously so. And it's in a clear uptrend as far as I'm concerned, and I'm going to stay there for a while. So here's my take. I like my ETFs. I'm watching the 200-day moving average, and I'm not delusional. I know this market is not cheap. And I'm not going to argue if things start slicing through the 200-day moving averages, the sell tickets are coming out, but we're a long ways from there right now. Next, podcast of the week. This is a new favorite of mine. I think I've been talking about this ever since I got turned on to it. This is On the Tape with Guy Adami, Dan Nathan, Dan Moses, and a guy in particular I just relate to. At 20 minutes, he echoed what I talked about last week, that the economy could be doing great, but stocks don't have to do great. And it's a little tough for relatively new investors to get their arms around or their head around this cognitive dissonance. It seems illogical, but we've been discounting, stocks have been discounting for the past year what we're seeing right now. All the things I just talked about. Copper demand screaming, China demand for agriculture screaming, the recovery, the uptick in interest rates. Here we are. And so now buying the rumors, selling the news occurs. And I just want you to be aware of that. It's going to be tougher to make money from here, in my view. So my take is the economy is not the stock market. Don't be distracted by the headlines of jobless claims and all these things. The point is to make money and look at your stocks, your themes, your ETFs, and make sure that they're behaving the way you want them to behave. Next podcast is the Pivot with Kara Swisher and Scott Galloway. And at 49 minutes, and I know I don't talk about individual names, I bring this up because these are probably in a lot of your portfolios, and Prof G has had some really good predictions, and I was just fascinated by this. He thinks that Goldman Sachs could face an activist in the near term. Sounds like he knows something. It's underperformed. I don't think it underperformed that much that someone's going to go in and shake up arguably one of the most respected investment banks in the planet. He suggests they go subscription, meaning you give ongoing investment advice as opposed to swooping in for a fee and a transaction, a merger or an IPO or what have you. And he thinks they should buy public. Now, public, and I'd love to get your feedback, anybody who's using this. This is touted by Prof G, because he's an investor, which he discloses and I disclose, is sort of a more responsible Robinhood. Less gamification, more education, and he thinks it would be a great way for Goldman Sachs to go down market to a certain extent. We'll see what happens. Next, he thinks Twitter should buy CNN, which I think would be fascinating. He lays out a very compelling case, and he's also one that predicted that Twitter would go subscription, and the stock's up above the 70 mark that he predicted, given their move in that regard. So something to pay attention to if you own those stocks. I just throw it out there for you. My take is his predictions have been pretty good. Next, charts tweets of the week. This is John Quakes, who's all over uranium on Twitter, and I recommend that you follow him. Mike Alkin, I also follow. He's the advisor to URNM, the ETF I just mentioned, and put some pretty compelling uranium math out there. Nuclear fuel demand's about 200 million pounds a year for the next 10 years. But at under 33 a pound on spot, only 40% of that demand is going to be met. And COVID has knocked down that supply as well. So he makes a very compelling case that we're at 29 right now. You got to have a double in the uranium price to induce all the companies we own in URNM to mine more and produce more uranium. And if you take the fixed costs, you put a double on the revenue line and then some, and bring that through the income statement, you're going to see earnings explode here for several years. And we're just getting started. So I just put that out there for your review. Next is another one from John Quakes, referring to a Bank of America report. I didn't know Bank of America even covered uranium, but apparently they do. Biden's platform is embracing nuclear energy, and this could delay reactor closures. They're going to expand the life potentially up to 100 years for reactor licenses, and this could add 26 million pounds to the global demand for uranium that we talked about before. So that's 15%, let's call it. The bullish points for uranium just keep piling up, and I'm looking for negatives too. I don't have confirmation bias, but I see what I see, and uranium's got a good number of years. And the next tweet really points to that. This gives you some frame of reference. So John Quakes was asked about the comparison of the timeline of the last uranium bull market. He thinks it started around February 2003 when uranium was around $10 a pound. It bottomed at 18 or so this time around. Last time had a 4.5-year run to $140 a pound in 2007. So, will that happen exactly? Probably not. But we're in inning 3, perhaps 2 or 3 of this ball game, and it's going to be exciting to watch, and I hope you're here with me to participate. All right, that's the show. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Please follow us on Twitter at BakesTakes_ and other social media. Please use your voice memo app. Murph, thanks a lot. Tape your questions and email to bakes@bakestakespodcast.com, or write in if you'd prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Thank you as always, Mike. Have a great week. This is Bakes. I've got two for you. This is the Adam and the Metal Hawks band. If you've seen them on TikTok, I think it's great. Guys with blue salad bowls getting whacked over the head playing guitars. But the guy can sing. He sings Sweet Child of Mine, Guns N' Roses, and I think it's fabulous. So made me smile. Hope it makes you smile. And then Brian Regan, he nor I thinks that Pop-Tarts should have directions, and I hope you get a chuckle out of that as well. See you next week. Take care now. Bye.